Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and I have two guests this morning. We have centre-back Nick from Newcastle, and we have Canadian Graham from, believe it or not, Canada. How are you guys doing this morning?
Thanks, John.
I feel like the intros get just more outlandish each week.
I do try.
Every week has another drink, and suddenly they're completely off topic.
Yeah, I've really taken to Bloody Marys these days. Morning, Bloody Marys. So we've got three topics this morning. The first one is we asked the key question in financial markets today, which is who is the ASX? Then we're going to look at parking spots. We feel stocks are quite expensive right now. Where do you put your money if you're not going to stick it in a term deposit? And then finally, the one sector that we feel has got some cheap stocks in it. Okay, let's kick off with the key question. Who owns the ASX? Nick, let's start with you.
Okay, well, in short, it's super funds. And I guess the reason or what sparks this conversation is I sent around a stat that from UBS the other day, which suggests that, according to them anyway, 49% of the overall Australian equity market capitalisation is owned by super funds. Yeah. And that's just a staggering amount. One in every $2 is owned by superannuation funds. I've seen sources that suggest it's lower, so somewhere between 30 and 40%. And intuitively, that probably makes a little more sense. I guess if you use some napkin math, the ASX is, if you include all the companies' market capitalizations and add them up, it's about a bit over $3 trillion, and our superannuation industry is a bit over $4 trillion. So if you assume they invest, say, 25 cents out of every dollar in the Australian market, that gives you about 33% ownership of the ASX. So it might be a bit lower, but either way, it's a huge number, and it's one that's growing and having a real impact on markets. It kind of reminds me of the Japanese bond market, where the Japanese government owns 50% of all government bonds. I mean, there's just this sort of crowding out effect that I feel like is happening here. And it's probably only going to get worse in terms of these superannuation funds are getting larger. They're consolidating assets. And so the bigger growing a lot faster than the smaller funds. And so they're really going after these large and liquid stocks where they can actually just put large amounts of money to work. And so there's a bit of a passive feel to this. And I guess another change that makes me think that is the new Your Future, Your Super Performance test, where essentially if the super fund underperforms, they need to send a letter to members notifying them of that underperformance. And so no one wants to do this. So everyone sort of tries to crowd and herd around the index benchmark. And so they're just sort of buying the same stocks almost in the same way that ETFs do. And so we sort of think about super funds as this active participant in markets, and I guess they are, but the behaviour suggests to me that they're actually becoming more passive as they grow.
Graham, what do you think this means for retail investors when half the money in the market is, I wouldn't say dumb, but isn't thinking as much as maybe we might be?
Yeah, I think it's interesting, and also interesting that Nick phrased it as things are getting worse, because my first thought was actually this is a sign that things are going pretty well for the super industry, that Australia's superannuation setup is like one of the best in the world, I think, in how it's structured. And so I see this as being a sign that it's working. And it's whether or not it's going more passive, it probably is becoming increasingly passive. Maybe that's a good thing too, because it's hard for active fund managers to outperform when they're trying to manage trillions of dollars. So they couldn't outperform even if they tried to. So maybe if they just focus on lowering their costs, that's actually better for the investors in those funds anyway. in terms of what it means for people who are wanting to own stocks directly, I think it probably creates more opportunities overall. If the person who you're buying from is acting passively without actually analyzing the stocks that they're selling to you, I can't see how that couldn't be a good thing. The whole argument that the ETFs and the index funds are growing and growing and growing, and that's really bad for everyone. I actually think if you're an active investor, that's good for you. It means that more and more of the stock market is acting automatically instead of intelligently, and that creates
without regard to price. You mean?
Exactly. They're just buying it because it's been added to an index, or that it's a certain size or meets some sort of other quality thresholds, but they're not looking to the depth of the company's financials or anything like that. So that's how opportunities arise.
Yeah. So we've got every year. I mean, it's a lovely business to own when you know that your revenue is going to grow by 10 to 12% a year every year, regardless of what you do. Like, I would love to be in a business like this. But can you make an argument, Nick, that we've got too many people taking a slice of this? Would we not be better off by, I don't know, extending the future fund and just having a couple of big organizations run it? Once you accept that you're not going to invest on price, why not just consolidate the sector and do it really, really cheaply and call it a sovereign wealth fund?
Yeah, I mean, you can. And look, I'd echo what Graham said about, the super system working. I'm not saying it doesn't work. It works. I'm saying it almost works too well, or has worked too well, in the sense that, if we have these passive investors looking, investing just more and more automatically, yes, that creates opportunities for active investors. But the weight of money here just means there just isn't that many opportunities, because we're talking one out of every $2. And so, yes, maybe there's some opportunities in small caps, but in those large caps, we might have thought as CBA was cheap at 12 times. But now maybe CBA is cheap at 25 times. So maybe we need to adjust our thinking here as well. And when I say this problem is going to get worse, what I mean is that the crowding out effect, unless they lower their percentage, which they might, and they probably will over time, is going to get worse. There's $4 trillion in assets today. There's a prediction that'll go to $12 trillion by 2050. If they still invest 25 cents in the dollar, which I'm suggesting they won't, but if they did, they would own the entire ASX, just super funds, which is kind of crazy. So, I'm finding it harder anyway. Things are more expensive, and I'm not saying this time is different, but and I am speculating a little bit. But you do have to think maybe valuations in the Australian market are permanently higher than they were before.
Yeah, I mean, we want to make it clear to listeners that we're not making a case to go out and buy CBA just because of the flood of money that's going to go into the top 20 stocks.
Yes, exactly. Yeah.
But, you'd have to say that surely, the country is too small to sustain a finance industry this large, don't you think? Are we going to have to go offshore and invest like the Norwegians do?
I mean, they already are, though. I guess I think 30%, if you just look at, say, Australian super, I think their breakdown is something like, for a balanced option, is maybe 30 cents in the dollar as international stocks. I think about 23 cents as Australian stocks, and the rest is sort of private assets, real estate infrastructure, and fixed income, maybe some cash as well. So I think they already are going offshore, and they actually probably don't like going offshore that much, because they have to take the currency risk, and there's all these other problems as well. But yeah, they're already doing that. So I still think that the weight of money here is just insane. And again, I'd stress, I'm not saying this time is different. It's just something to think about.
The system is different.
It is, and it does make you question whether you can afford to be out of the market for long periods of time. Or hold cash for long periods of time when you've got this natural buyer here,
right,
that gets 12% of the country's income every week coming in.
Yeah, that's right. That's a big hand out.
Yeah,
asking for your investment dollars, which brings us to the second segment, which is parking spots, because that we feel as though generally stock prices are quite expensive, unlike the super funds who are just buying up anyway. And traditionally, when you think things are expensive and you can't find many places to put it, you would put it in term deposits and hold a little bit in cash, which I think many investors are doing right now. Many value-orientated investors are doing. But Graham, are there other places where you can earn more than a few percent on the money that you put in the bank waiting for cheaper prices?
Well, I think there's always places that you can find more than you're going to get not always, but there's usually places you can find that will get a higher yield than you'll earn in a savings account. But the risk associated with that ramps up pretty quickly. Yeah. So it's a hard toss up. If you're desperate for an extra bit of yield, then stocks probably are still the right place to put them. And you could go for safer infrastructure stocks or higher yield infrastructure stocks if you're wanting to get it a little bit safer than the average stock, but still earning a bit better than a savings account.
Yeah.
But I've always kind of thought that you need to first be clear on what you actually want to achieve, and the money that you're trying to keep safe. If the savings accounts are paying 3% versus 5% however long ago, then that's just what you got to accept. There's no way to get around the lower yield if your primary concern is safety. And for the money that you're willing to let sit for 5 years or 10 years, then stocks probably are still the right place for it. You might just want to skew them a bit more to stocks that are less exposed to big economic swings or that aren't ridiculously valued and so prone to crashing randomly.
Yeah, Nick, we've had some big winners over the past 6 months or so, and some of us might be selling down. What is your feeling about what you should do with the money that we generated over the past few years, and where you should put it to kind of not sacrifice your returns, but just be happy with a modest return with much lower risk? Are there any options for people who want parking spots?
Yeah, I don't know if I would classify them as lower risks or parking
that's the problem,
spots.
right? There's always a trade-off.
Yeah. Look, I think if you are holding cash, it's important to be patient right now. Equity markets, whether it's Australia or the US, are extremely expensive. But I guess another way of answering your question is where I'm seeing opportunities, and I'm actually seeing opportunities in, stocks that have had a hiccup or there's a turnaround going on. Mm-hmm. And I think when the market's flying and a company goes, does have a hiccup, investors just tend to sell it straight away because they want to chase the thing that's going up. They're told every night on the news the market is rising and their stock is falling. And so you have a lot of investors, when a company does go through a hiccup in these periods, acting on emotion rather than on the fundamentals of the company. And that can create an opportunity for patient long-term investors. Another opportunity, I think, is non-US and, to be fair, non-Australian stocks. European markets, and I know I always bang on about it on this podcast, but the UK's market looks a lot cheaper relatively to the rest of the world. And
you've been there lately, and you've seen the state of the place, Nick, don't you think?
Yes, yeah.
There's a good argument that the UK is screwed.
Yeah.
And I'm not just talking about the food.
No, there is, but I guess like one, we have found one company that we've written up in two parts today, and its buy idea, it sort of combines what I'm talking about. It's a UK business, has had a hiccup, but it's a large company, it's growing. The outlook, I think, still looks good, and it trades at a massive discount to similar types of businesses in Australia and the US. So there are opportunities, but you have to sort of squint and look hard. I guess another area is healthcare, and I know we're going to speak about that, but I saw one stat the other day that the healthcare sector, if we just look at the S&P 500, has underperformed by about 40%, which is the widest margin. It's underperformed by 40% since 2023, which is the widest margin it's underperformed since in the last 2 decades. So that's another area which on a broad sector level looks a bit neglected at the moment.
Yeah. I mean, I think also if you look at Asia as well, which I feel as though is going to be economically much stronger over the next 20 or 30 years, and you look at the stock prices I'm not comparing China to the US in anything other than valuation terms, because they're two totally different investing environments, although they're probably getting a little bit more similar as time goes by. The difference in prices with the big tech stocks in China just look half or a third of the price of the big tech stocks in the US. But Alan Kohler was going on about Japan last week, and I think he's put some money into a Japanese ETF that's coming out of a 20-year hibernation. So there are places where you've got relatively cheap stocks, but you do have to embrace different kinds of risks. You've got currency risks, you've got economic and political risks. I think South Korea looks really cheap at the moment, but look at the politics there. It's no more reassuring than elsewhere. So this is a thing. You think about a safe parking spot, and then you have to sort of cross out the word safe, and you end up back at term deposits or infrastructure stocks that you were talking about, Graham. But then there's often debt associated with the infrastructure stocks, and you take airports or very much leverage to economic activity, and this is always a trade-off you have to do. So I think the other point is, and I don't know what you guys feel about it, but I'm kind of very worried about where the US is as a country politically and economically. But it's important to kind of try and challenge your own thinking. So if you are panicking about the US and maybe your exposure to US markets, you do also need to consider the bull case for the US. and I can hear people saying, well, what is it? And you can imagine a situation where interest rates fall very rapidly because Trump gets the people he wants on the Federal Reserve. He might just turn around one morning and just say, right, that's it. Tariffs have done their job. Everybody signed a trade agreement. We got what we wanted. We're pulling down the tariffs. You could see a world where this continues for a few years, couldn't you?
Absolutely. I mean, if you look at the .com bubble, and you think about Netscape as the sparking idea of that was 1994. The bubble didn't pop until sort of 2000. And so if you sort of look at ChatGPT as that as well, we're only sort of mid-innings. That's
right. And ChatGPT's got revenues, like 700 million users. A lot of them paying money, so it's different in that respect.
Yeah, it is. You can definitely create a bull case for stocks and for these valuations. Though it's important to remind people history, isn't on your side. But who knows?
Yeah. Graham, I feel as though we're all predisposed towards pessimism, not just in the investing sense, but in an evolutionary sense.
That's a very pessimistic thing to say.
But, it's much better to be pessimistic than optimistic, because most risks don't eventuate. But the ones that do, if you're prepared for them, then your chances of survival are increased astronomically. And you have to account for those risks that can wipe you out. And I think investing is kind of similar to that. But we've got to be careful about not being too pessimistic, because I think investing is a fundamentally optimistic thing to do. And if you bring a pessimistic mindset to it, you end up in 50% cash, and you might as well not be investing at all. What do you say to that?
Yeah, I think from my own experience, it's been very similar to that you can avoid a lot of disasters, but it can also cause you to sell too quickly. So you end up not staying with the winners long enough when they could completely offset your losses from any losers. If you lose 100% on a stock, it's one thing, but if you go up tenfold on your best idea, then that offsets tons of losers. Right. So I think you do have to be kind of fundamentally optimistic to invest at all, but it's important to be aware of the risks and to not be completely willfully blind to them, in the sense of just investing for the sake of it, or investing in a lottery ticket kind of way where you're just hoping something goes up. I think it's always very important to ask yourself whether you're hoping the share price goes up and someone else just pays more for it to you, versus you really are thinking of this as you owning a piece of a business and you understand why that business is going to do well over time, why you think it will be more profitable 10 years from now. It's much better to think about the business than what the other investors will do or what the market might do or anything to do with the big macro stuff, which is so unpredictable, particularly with the US right now.
Yeah. Agreed. Okay, so let's move on to the final segment, which is the one sector where we feel as though there are some cheap stocks. Graham, tell us what it is, even though Nick's already told everybody.
Yeah, well, when Nick said I hadn't heard the stat about healthcare underperforming by 40%, but after this reporting season, it definitely felt that way. So I can believe fully that healthcare is undervalued compared to the rest of the market at the moment. And the big one on the Australian market was CSL. Funnily enough, it had a pretty reasonable result. Its revenue was up 5%, profits were up 11% or so, and the core of its business, its antibodies segment, was up 7%. So all of those figures are fine. It's beating the overall economy, and profits are growing faster than revenue, and like on the face of it, everything looks good. But it had this was a really strange result compared. I've been following it for about 10 years now, and I would say it was, just much more disturbing than any other result for two reasons. That the company, it's one of the oldest in Australia as well. It's more than 100 years old.
Yeah.
And it's always been about the long term. The whole business model revolves around you make these large upfront investments in research, and that might pay off 10 or 20 years from now. So something I really admired about most of the CEOs over its history have been that they're very forward thinking. They're not thinking about how to boost profits today. They're thinking about how do I boost profits for potentially the next CEO, not even getting to enjoy the spoils today or in the next few years. So what was bizarre about this result is that it really had this air of short-term thinking among management. And the big thing was that they're spinning off their Seqirus vaccine division, which isn't a huge part of CSL, but the spin-off just seems so random. It's run completely isolated from the rest of the business. So there wasn't some, magic distraction that was going on. It's been there for basically since CSL began. This side of the business was around for the Spanish flu, let alone COVID. This is from 1918. That's incredible. It's been with CSL from the beginning, basically. Incredible. So why spin it off now? It's a core part of the business. But
so why are they doing? Have a guess.
Well,
what do you think it is?
My best guess, because I had to do some real thinking for this, and management didn't really have a great answer, I thought. But my best guess is they're actually doing it for political reasons.
That's what I reckon.
The only thing that I can think of that makes it make sense is that vaccines are very unpopular at the moment in the US administration. Yeah. And you don't want to be the world's second largest vaccine maker, particularly when your big money spinning division, which is the antibodies side of the business, is attached to it. So my guess is management may be doing it looks short-term thinking, but it may be the sensible thing, which is get rid of the vaccine division. That way Trump can't come with a hammer to the antibody division as some sort of punishment or threat or something like that.
Right.
So I'm hoping it's that reason, because that does have a little bit of sense to it. It's a sad case that may be the reason behind it, but at least I can see management's rationale.
Yeah. And you can imagine that even in a massive measles outbreak in Texas, it probably wouldn't change their thinking. No. So I think there is a rationale there. Nick, have you got any ideas why any guesses as to why CSL should sell off a business that we all need and has been around for a long, long time and is doing pretty well?
No, I don't. I can't add too much. The only thing I would say is it's just another example of why, as investors, we just need to have really open minds. I mean, just rewind 10 years ago, no one would think that someone was, CSL would sell off a vaccine, their vaccine business, because the government was all of a sudden questioning the efficacy of that business. You know what I mean? Like it's completely crazy. But no, I don't have anything more to add there.
All right, Graham. So they sold off their business, possibly for political but understandable reasons. What about the rest of it?
Yeah, the rest of it was also a bit surprising. And we've, funnily enough, got an update just a couple of days ago showing how this strategy change can affect it. So the company's cutting around 15% of its workforce, which is a few thousand people. So it's quite a cut. And it's closing some plasma sites and it's consolidating some of its research facilities. Actually, it's shrinking its research facilities by about half. And management is targeting from all this around $500 million of savings over the next few years, which on the face of it, okay, great. Everyone loves savings. Nobody likes losing their job, but it's good for the investors in this case. Yeah. And however, CSL isn't an ordinary company where you can just cut your workforce, bank the extra dollars, and you're good to go for higher profits. This is a company where that spending on research is, as I said earlier, that's profits 10 years from now. Yeah. And so for anyone who is actually wanting to be a long-term holder of the company, I don't think cutting your workforce by that amount, cutting research spending by that amount is good for the long term. That it'll boost short-term profits, but that's going to leave some big holes in revenue 10 or 20 years from now when the current set of medicines and drugs that it produces have gone to generics. They're no longer being covered by patents anymore. This is a company where it has to keep investing in innovating new drugs and therapies to replace the old ones, which get outdated, which are made obsolete by newer products made by competitors, or they just go off their patents and end up becoming generics sold for really cheaply. So I don't think the cost cuts are something to be enthusiastic about.
Is there anything in management incentives that might explain this behavior?
Well, the management incentive, which I think is driving this, is that the share price has come down so much from its highs, and they have experienced a slight slowdown in revenue growth. I don't think there's anything to panic about, particularly when it's still able to grow profits by a decent clip. Maybe investors need to be a little bit more subdued in their growth expectations, but it's not some disaster by any stretch. So, however, I think management is feeling the pressure of the share price and it needs to put out some big expectation-beating figures over the next couple of years or it's going to be on the chopping block. So I think they have done the maths in their head and they've decided, look, we need to get profits growing rapidly again.
Right.
And if we don't, we're going to be without jobs in a couple of years. So, I don't think it's about their incentive structure in terms of their direct pay or anything, but there's obviously a ticking clock for management that's in a stock with a falling share price.
Yeah. Yeah. I should disclose that I did buy some after the bad news, and the bad news has continued. We've, as usual. So I think when the result came out, it was on the 18th of August, Graham, it was $270, and now we're down to just over $200. It's quite a substantial fall. This is a situation where you have a good business going through a tough time where we often make money, which is why we've decided to launch a members-only podcast, which is coming out next week, called Stock Take Deep Dive. And CSL is going to be the first company we're going to examine in that monthly feature. It's for members only, so if you'd like to listen, please sign up. But we're going to go through the investment case for CSL in great detail with Graham next week. So that brings our podcast to a close for this week. Thank you both for joining me, and we will be back with you in a couple of weeks.